Good evening. In this video, I'm going to explain how to enter and exit option contracts for day trading, the 0DTE options that I run in my plays, for my streams, or when I'm trading. So, I use Webull. So Webull is just a brokerage account in which you can trade stocks and options and things like this. So, number one, you need a brokerage account that allows you to trade options. There are different variations. This is just the one I use. I'm just going to give you a very basic and simple rundown of how it works and what the mechanics are. So options could be very complex. However, for our purposes, we don't need to get into the nitty gritty. I'm going to give you the meat and potatoes, exactly what you need to know. So here we go. Basically, this is what's going to happen throughout the day, or in the morning session, afternoon session, whenever we're trading. I'm going to, make the call outs or give the suggestions or say your risk is here, your risk is not here, X, Y, and Z. So let's say, for example, I say right here that you see this green arrow and I say buy a call here. So what you're gonna have to do is go into your brokerage, right? You're gonna open your option chain. They're gonna be different. I can help you if you need help with it, but this is pretty much what you need to figure out on your end, right? You need to open your option chain. Once you're in your option chain, you need to choose calls. Now there's an you can have both, right? But this is a little confusing, right? The calls are on one side, the puts are on the other side. But I like to do one by one because I've been burned in the past, so it's fine. So I'm going to choose a call. And now you're going to see also you need to be at the proper day. So let's say it's tomorrow the 5th. So I'm going to bring open the option chain for the 5th. Okay? So the current price, this is just an example, okay? So the current price of SPY is 601.78. Now, these prices are elevated because it's for the next day technically, but there's just for these purposes, we're going to use these numbers. So if the current price is 601, now we're making up numbers. Let's say this is 601 right here when I told you to go in, okay? So what you're going to do is buy a call. You're going to go to call, and then you're going to choose the call you want because there's all these different options, right? So you're going to choose the contract you want. These are contracts. Everything is times 100. Not the price, but the value. You'll understand in a second. So the price is the price. So when you see, no, it is times 100, right? So $2.06 times 100. So this contract here, if you choose it, you're gonna click it, right? See how it's highlighted and clicked? And then I'm gonna go to buy, and I already have mine set up. So it's gonna be, for example, yours should be 1, because you're just starting out at 1. One contract, it's verified here, right? Here's your call for this day, for this 601, right? And you're gonna pay $200, buy, okay? So when you buy, it's gonna put the order in, and it'll say your order at 206 right here. So on your chart, you can set it up for your chart to where it shows you your entry price. So on your chart, it should look something like this, right? You'll see an entry price. It'll say where you entered at, 206, right? And then along with this, you can add in your stop loss, so it automatically generates a stop loss. And you can put a take profit, so it'll automatically put a take profit. So on a call, you want the price to go up. You're betting that the price is going to go up. So your contract will start at 206 value. Remember, that's $206. And remember, the prices are elevated. These aren't normal prices. This is for the next day. So let's say we're doing the same day, the prices will be very different. Not too much different, but different. Anyways, so your value of your contract is $206. That's basically saying that's how much you paid to play the game. Now, if you're right, that contract is going to go up in value, right? Now, as you go up, look at the value over here. So from 206, as it goes up, as the price goes in the way you want, the value of your contract gains value. It gains value. So if you were to get, let's say it went from here all the way back up here, you made in this play right here, from here, where is it, 206 to the top of this, we'll do the top of this, 301. So how much did you make? Because you started out with 206, now you're at 301. Let's just go up a little bit more so it's even. You started at 206 and now it's 306. So in this move right here, that's $100 you made. So where stock, you're buying one share and it's going up. If it goes up this much, you made cents. However, in options, right? So if you own one share of SPY, it costs what is it? $601 at this point. And if it goes up $1, you literally get $1. But with options, right? Because it's leveraged and everything's times 100, and you're only trading the value of the contract. So you're gonna buy a contract at 206 right here. You see it where it says 206. Okay? And then when the price goes up, you can exit here if you'd like to take your profit. So you get the difference, because then when you get here, you can put your stop loss, you can move it, right? I'll get into that later, but here's what you need to know. When it goes up, when it goes in your direction, the value of the contract gains value, right? So then you pay 206, but then you exit at 306. You made $100, and that took 1, 2, 3, 4, 5, 6 minutes. This is a 6-minute play. Okay? From the top of here to, because each candle is 1 minute. So 1 minute, 2 minute, 3 minute, 4 minute, right? So this is 6 minutes to make $100. And this is the value of trading options, because it's exponential growth. Okay? So I'm all about managing risk. So managing risk, you gotta have a stop loss. So I like to automatically put a stop loss on. You don't have to do 15%. You can do whatever's comfortable. I don't like to put a take profit, because sometimes the price will move up so fast and you'll hit your take profit and it'll get you out of the trade and you could have made more. However, I do like to use a stop loss. So let's see if I can, okay, another thing. This is Webull specifically, I don't know if it'll work differently on your brokerage, but if I were to choose this contract, right, as soon as I click on it, or this one, or whatever, you see how the screen's changing? So if I choose this contract, and I want to go close to the money, I'll explain to that later. I'll get into that later, but I'm choosing this contract, or this one. Now on my bigger chart, because I just have a bigger chart, it'll change to the option, or to the option chart. So it's going to look different slightly than your actual SPY chart. It'll mimic it, but it's slightly different, okay? So just know that. And then what'll happen is this. I wonder if I can do it. Let me see if I can do it on here. Okay. So what'll happen is, I should have done this before, sorry. Okay, here we go. So on this big chart here that you should have, you're gonna see your position. Your position will be off to the side, somewhere off to the side. Like, so for example, when that 206, it'll say, boom, when you buy 206, it'll say position one contract at 206, off to the side, right? And then when you have this, let me close this. And then when you have this automatic sub order, the stop loss, it will automatically generate another one of those. So it'll automatically generate another one of these that'll say sell. So it'll look just like this, and it will be exactly the percentage you put for your stop loss. So let's say you bought a $200 contract, 15% of $200, right? That's $30. Because 15% of $100 is 15, so times 2 is 30. So your stop loss, if you buy the 206 contract, that's how much it costs, right? If you buy the 206 contract, your stop loss will automatically generate $30 under, okay? So you'll have a little tab under where your price is. So what that does, having a you don't want too tight of a stop, right? Because let's say you bought this one right here, and then look, this next candle, it goes down, and it'll stop you out if it's too tight, and you'll lose whatever the money is that you put for your stop loss, okay? So you want to give yourself a little bit of cushion, right? So if you're in here, if you see this move, and you go in here and you get filled here, you want to put your stop loss below this. Because if it goes below that, you know the trade's no good anymore. You might as well just take your loss and move on. You could hold on to it if you have conviction and you think it's not going to break your stop. You could hold on to it. But this is what this means. So if you go in at 206, it'll automatically generate a stop loss order because you're buying it. So it's going to do a sell order down here. Now, as the price moves up, you're going to have to grab your sell order and literally drag it up. But you can't drag it up too fast because you might, again, stop yourself short, right? So let's say, let me try to find one. Okay. Let's say you went in here, right? And then the price goes up here, goes up here, goes up here. In this 1 minute candle, the price is fluctuating up and down. So if you put your stop loss inside this candle, it'll fluctuate up and down and stop you out. You have to wait till the candle fully closes, right? Before you can move it. And then sometimes a candle will go inside of the last candle. So let's say you're on this one and you move your stop loss up, but then look at this one, it goes below. So if you have your stop loss too tight, so let's say you went in here and you moved it up, moved it up, moved it up, and you're here. At the top of this is where your stop loss is, and you're still in money, this candle comes, it goes all the way down here and stops you out. So that's the risk of putting your stop too tight. Because even though it's still moving up, this candle has movement from the top to the bottom. So you got to give it a little space. What I recommend is, if you go in here, you wait 3 minutes, 3 candles, 1, 2, 3, then you move it to this one. Then 1, 2, 3, then you move it to the bottom of this one. 1, 2, 3, then you move it to the bottom of this one. That's just a rule of thumb. But look at this. Imagine if you went the opposite way and you're buying the put, right? Look at this long wick. This thing can stop you out for no reason because then it continues down. So these are some of the risks. I'm just showing you what the risks are. But, so let's do it the opposite way, okay? So let's say I told you to buy a put, right? The red. So you're buying a put. So you would go to your brokerage, you click on put, and then you say, okay, I want the 239 put. Now, if you notice, because the put goes the opposite direction, it's the down, it'll invert the chart for you. It'll invert the chart, right? And the 239 or 235, boom, 235. Your stop loss will automatically generate 15% below that. You can change whatever percentage. You can change it to a dollar amount. Let's say I just want $20 stops, or change it to the dollar amount, change it to ladder, change it to the percentage. You can change your stop loss however you want. I don't recommend a take profit. I do recommend a stop loss. Take profit only if you're going to be away from the computer or something like that. Or if you have a specific target in mind that you just know that it's going to hit. Take profits aren't bad. At least, take profit's good. But anyways, so if you buy your put at 235, now you need this price to keep rolling. So on this chart, it'll look like it's going up, but on the real chart, it'll be going down, right? Because it's inverted now. So then Price goes up, price goes up, price goes up. You move your stop with it slowly, slowly, slowly. Don't go too fast. Give it 3 minutes, 4 minutes. You got to let the trade develop, okay? So let's say I tell you that, all right, you're in this trade until it breaks this blue line. What that means is you're waiting until the price in your regular chart, right? This is my trading view chart. You're waiting until this price breaks this blue line. So it broke the blue line here. You know, boom, it broke the blue line. You see it building power broke the blue line. You go and then you move your stop and stop out wherever the price is. Or you could, there's a way you can just close your position. You go to your positions and just close it. Close position. But if you have a stop loss, this is how I do it on Webull. I'm sure it's very similar to other platforms. Very similar. But that's something you're probably going to have to figure out on your own if you're using something else. I could maybe help you out a little bit. I can do what I can, but this is how it works. There's a lot more intricacies to option trading. But for what we're doing here, all we need to know is that. Okay, another thing. There's something called delta. I'm not going to go too far into this because it's not that important. The delta is essentially your risk. So the higher the delta, the more expensive the contract. So what this means is if SPY moves $1, you're getting 53% value in the contract. Okay, if you get this contract. If you get this contract, if you pay $2.90, if the SPY moves $1, you're getting 61% of that move. You understand? So if you buy this contract, the 603, if SPY moves $1, you're getting 69%. So the higher the delta, the more expensive. So technically that's more risk. The least risk is the lower delta, right? But here's a problem with the lower deltas. If the delta's too low, you'll have to make big movement to get any value in your contract. The movement will have to be a lot more to get any value. You understand? So if you only did a 31 delta, the price would have to move a lot to move that contract, a couple dollars. You see the difference? Like, let's say you got this 88. Let's say you got an 88 contract, and the price moved way up here. Way up here, you made 40 something bucks, where opposed to the other one, at the 50 delta, you made $100. You see the difference? How a lot more movement needs to happen, but you're taking less risk, right? So that is how the trading options should work, right? So if I'm giving you the call out, you're going to your brokerage, you're doing, okay, call, boom, close to the money is the best balance, right, between movement and price. It's at the money, wherever this is. You see the at the money price, wherever this is, and then you click buy, and then it'll put your order, and then your stop loss should automatically be generated, and you watch the profits roll in. Hopefully, right? That's the goal. But I did receive some feedback regarding this. People just don't know exactly the mechanics of how it works. It looks so easy, but I don't know exactly what I'm doing, and there's going to be some research you're going to have to do on your own. But this little video I put together, hopefully it gave you a little idea of the extent of what you're going to need to know, right? So find your option chain, wherever it is in whatever platform. You need to know if you're buying a call or a put. You need to select the contract, hit buy. In mine, I automatically generate my stop loss. So then I'm just chasing it. I'm moving the stop loss accordingly. Every so often, I'm moving the stop loss. And then if I want to take profit because I think it's going to go the other way, I put the stop very tight. Very tight. So then any movement down, I get stopped out, and it triggers an automatic sell order. See this sell? It triggers an automatic sell order. Because when you're buying the contract, it's a buy order, and then you have to get your money, right? So you sell the contract back to get the profit, whatever it is. Or you sell the contract, if it goes against you, you have to sell it for a loss. Or you get stopped out, whatever it is. But This is the overall idea of how it should work. It's not too complicated. Again, I recommend you start with paper trading. Paper trading is a good tool to see how the market moves, how tight you should put your stops, if you keep stopping yourself out short, if you need to let plays run longer, let your winners win and cut your losses, cut your losers. Because lately I've had, a pretty phenomenal run, a pretty good run, a month and a half of straight solid plays. But those days are going to come where I call the wrong way, or something happens in the market where some political leader says something and it triggers this and that. You know how it goes. So you can't prepare for those things really, but what we can do is manage our risk. And how do we manage our risk? By putting stop losses that we're comfortable with, okay? Taking profit when we can take profit. So when I'm telling you that we're going in the uptrend, you got to chase it, means you got to let it develop a little bit, and then once you're in money, then you move your stop, right? Once you're in money, then you move your stop. If you held on past this blue and held on for this, good for you. You have more what do they call them, cojones than I do. But because when I see this is just these are my rules, right? So I set up rules for myself because I treat this like a business. These are my rules. Whenever I see it break this, okay, I'm out. Those are my rules. You may have your own rules. Maybe you have some other information that says, hold on a bit longer, you can ride this wave. But you have to imagine that if you went in here, chances are you got your fill at the bottom. This candle would have went above your entry. So it technically would have stopped you out already, right? This one candle, if you had a tight stop. Now, if you had your stop up here and you gave yourself space, let's say you gave yourself $25 space, then this candle wouldn't affect you and you still have room to go. But these are mechanics you're going to have to learn on your own to see your own risk tolerance, right? This is something because everyone has an idea of how they would play the game, and it's easy to say what you would do after the fact, right? We can look at this chart and say, oh, okay, buy here, sell here, right? Buy here, sell here. It's easy to say that now, but when you're in the trade and you have no idea what's going to happen, everything changes. Once you open your wallet, everything changes and it really tells you who you are as a person. I'm telling you, you're going to go through all the emotions, right? So I recommend you start with paper trading. There's no risk there. And you keep a log, and you actually keep a log of what you did, how you would have performed, where you made your mistakes. Did you get out too early? Did you stop yourself out too early? Did you make the wrong call? Did you enter too late? Because a lot of times we hesitate, right? We hesitate. We're like, oh no, I don't know. I hesitate. And then the play goes and it goes on, and then you get something called FOMO, fear of missing out. And you're like, okay, well, I'm going to get in now. And by then it may be a little too late, and then you get one candle that goes against you, you get stopped out, and then 1 minute later, it goes in the direction you thought it was going to go, right? So that's all managing the risk, and that's why I always say, if you missed a play, oh well, you missed a play. There's another one around the corner. Don't chase. I never chase. If I missed a play, I missed a play. I can do this every single day, making, five figures comfortably every day, okay? So I'm not worried about this one play that I missed, because I have a mix of style, right? Sometimes I'm scalping, sometimes I let it run and I do the swing, right? So it swung from the bottom to all the way up here. That's technically a swing trade, right? Scalping would be kind of like this, like you go here and you get out real quick. You do a whole bunch of contracts and you get out. So imagine if you did this play right here, where you did let's say you got in here at 206 and it went to 235. That's it. 1, 2, 3, 4, 5. Couple minutes move, 6 minutes move, right? $30. But imagine if you were very convinced and firm in it. If you put 10 contracts and you had $30 per contract, now you're talking about a $300 day, right? Now you're talking about a $300 day. So this is how you're going to start to level up at this point. So start off with one contract. Start off paper trading, and then you start off one contract at a time to see how you react. Once you start leveling up, you're going to do maybe 2 contracts this time. I want to double the money. 3 contracts, then you level up your account. Now, next thing you know, you're at 10 contracts. Easy. So these little small moves are going to be about $300 in 6 minutes. And this is why option trading is awesome. Like I said in one of my intro videos, that because it's using leverage, so you can capture a lot of money in a little move. You just need one. Okay, let's do this one for example. You got in at 184, right? 184. Let's say you got in here and you rode it up to here. This one candle alone, this is a 1 minute chart. This one candle from 183 to 225 in 1 minute. You can do this, right? In 1 minute. Look at your 2 minute and 3 minute. So if you get in here and you ride it up to here, that's an awesome amount right there. 182, 246. 60 something bucks times 10, $600 in 3 minutes. Right? But you have to get to that level. $600 in 3 minutes. Imagine doing 10 contracts at a time, 20 contracts at a time, 50 contracts at a time. You're not working at this point. You quit work a long time ago. Right? You showed up to the job with a joint in your mouth with middle finger up. Okay? So, but there's levels and there's steps to it. And you're going to go through some stumbles, but you know, I'll be here teaching, guiding, doing what I can. You're going to learn, and you're going to have to learn the market. If this is what you want to do, you're going to have to learn and feel the vibe of the market. I'm sorry, it's a thing. Because sometimes if I come in the middle of the day, I'm like, oh man, I don't know how the market is. I haven't been here all day, and you know, I don't have my lines up, and it's like that sometimes. And there's sometimes you just don't trade. You know what? I'm not feeling it. So I have, you know, kind of rules around certain things, and we'll get to it when you get into the Discord. So I hope this video was helpful. If you have any questions, please leave a comment. Send me an email to livespytrading@gmail.com, and we can work out any questions you have. If you want to join the Discord, we're going to start up a Discord, and it's going to be pretty good stuff. We're going to be changing lives over there and making big moves. Okay?